about identifying the market. We talked about making sure that our strategy matches what's happening. We talked about some entry rules that you identify prior, like we're making sure we're trading with the trend, making sure that the
but we're not trading with the trend. That's the key factor. In a breakout trade, you're trading against the trend.
The longer term uptrend, like the mother
hasn't even started. In a breakout trade, we are betting against the trend.
Yeah.
Because the prevailing trend has been down, and we're saying, that's about to change.
Yep.
We're walking against the light.
And you're waiting for the breakout above, and then we're looking to make sure that the volatility is there as well, using the count back line. To identify these trading opportunities exhibiting that criteria, I can't imagine you're eyeballing every chart. Do you have like those basic things coded in and you're scanning the market for things exhibiting that criteria?
Yeah, we have a number of explorations that we do that get us to the general area quickly. So the GMMA scan that you developed a few weeks ago and finalised for us allows us to do that much more quickly. So we can find all of those stocks where we've got a GMMA crossover taking place within the last 3-day period. So once we see that compression crossover developing, that goes on let's call it a stock pool.
Yeah.
So on that stock pool list 1, we've got all those stocks that meet that technical scan.
Yeah.
Then we can go back and look at those visually and say, okay, do they meet our downtrend line scan?
Yeah.
The answer is yes. Okay, that goes on stock pool list 2.
Yeah.
Now, 3 days, it's too soon for a countback line signal. So we look at that stock list 2, we watch that over the next 3, 4, 5, 6, 10 days. Once we get a CBL confirmation, then that becomes a trade opportunity.
Yep. So we enter into the trade because we've identified it now and we've been watching it, ticks all of our boxes, we're into the trade. Obviously, just before you get into the trade, you want to do position sizing and figure out your initial stops and trailing stops. Can we talk through how one...
Position sizing, the basic rule we use is that you don't put at risk more than 2% of total capital on a single trade. Now what that means, of course, is not that you've got $100,000 so you only take a $2,000 position. What it means is the difference between your entry point and your stop loss exit point, the total loss is not more than 2% of your total trading capital.
Yeah.
That's the key factor. How do you decide that? Okay, what do we use to define the trend breakout? We've used trend line, GMMA and countback line, or price volatility. So when we take our position, we use exactly the same methods. Because we look at a breakout, we can't use a trend line to define the rising trend. Not enough price data at this stage, so we can't use that method. Sometimes you can, but often you can't. So you've got to use price volatility. So we use the countback line to set a trailing stop loss. Take the highest high that's developed after the new breakout, do the calculation. There's my stop loss point. So my plain entry point is here, my stop loss point is here. Whack that onto a spreadsheet, work out what my maximum position size is.
Yeah.
That's the first thing. Given my entry and my exit and my risk control, then I can spend $100,000.
Yeah.
Unfortunately, I haven't got $100,000. I can only spend $10,000.
Yeah.
So I will take a $10,000 position, and that actually reduces my risk.
Yep.
The first calculation is the maximum position size. I enter here, exit here, and I lose 2% of capital. That's my maximum size. Then I usually scale back from that.
Yeah.
Now what that means is that I may say take a $10,000 position at this point, and I can exit here, and I will only lose $300.
Yeah.
0.3% of my total trading capital. It's like an airbag.
Yeah.
In a car. So you've hit the stop, the market's gapped through it, which is what it tends to do these days, so it closes 2 or 3 cents lower, but because your original stop was only 0.3% of capital, you might actually blow it out to maybe 1% of capital. So you're still under your 2% limit.
Yep.
So you can use you adjust your position size to also reduce your risk in another sense as well. So it allows you for gapping activity, it allows you for overnight volatility.
Now, we were talking about, the current volatility in the market, and I think one of the ways that you talked about for combating that, I'm assuming we're setting, especially if you're needing to scale your position sizes back like that, you must be having your stops set reasonably tight.
The stops are set reasonably tight in relation to the trend volatility. Okay.
Yeah.
Before 2008, we assumed that trend volatility was the same as price volatility. When you use countback line, average true range, chandeliers, all these sorts of approaches, they are using price volatility as a proxy for the behaviour of trend volatility. And that was pretty good. When we use a trend line, we do exactly the same thing. We put the trend line under a rising set of prices and we say, this defines the volatility of price, We don't expect price to drop below it. And this also defines the rising trend. So price volatility is the same as the trend. 2008 destroyed that. It still hasn't happened in 2009. So what we developed in 2008 as a short-term solution to volatility in markets, we are now finding applies in a longer-term basis, and we call it trend volatility line. What happens is that we use the relationships in the Guppy Multiple Moving Average. Now, GMMA is for ease of comprehension, as it were, defining what traders are doing and what investors are doing. It's actually describing heterogeneity in the market, but it's easy to think about traders and investors rather than the more technical terms. So we know that investor behaviour defines the trend. The wider the separation, the stronger and more stable the trend. Trader behaviour can drop quite dramatically into that long-term group. As long as it doesn't penetrate below, then the trend is probably pretty much in place. So what we do is, first of all, we use trend volatility, TVL, as a way of managing our exposure to the trade. It doesn't define the beginning or the end of the trend. It tells us what we need to do in relation to our entry point. So when we make an entry, it's like everybody, you've done all this research and you buy the stock and you hope that you've made the right decision. And then later on you become more confident that you've made the right decision and eventually become certain that you've done the right thing. You can define those points exactly. So take your entry point. What we do is, and this is all in the DVD, the Trend Volatility DVD, we explain in much more detail. So you take your entry point and you essentially draw a horizontal line. That's your reference point. That's your break-even point. While price is above there, that's okay. If it hits that level and you get out, then you're going to get out of break-even. That's your entry price plus whatever you paid to get in and plus whatever you have to pay to get out. So when that entry point, when that break-even line is equal to the lower edge of the short-term GMMA, you can be much more hopeful. You have confidence that your trade's developing correctly. When it intersects the upper edge of the long-term GMMA, you move into a situation from hope to confidence. When it intersects the lower edge of long-term GMMA, you can be very certain that you've made the correct decision, that the trend is stable and reliable. So that gives us positions where we can scale into a trade with exact points. No guesswork. That's where we do it, that's where we do it, and that's where we do it. Or you just take your single position from the beginning and you don't scale in, but you have a measure of your change from hope to confidence to certainty. But then what's important is we then need to define the trend volatility, not the price volatility. And we do that by looking at both the amplitude of the trend and the duration of the trend. Now amplitude we simply get by, we've got this break-even line coming across. Once it intersects the lower edge of the long-term GMMA, we draw a vertical line to the upper edge of the long-term GMMA. Much easier to see it on the video. I can assure you. So that gives us the amplitude of trend volatility. Not of price, of trend volatility. So the more strongly supported that trend is, the greater the amplitude. Then we draw a horizontal line. Now at this stage it just projects into the future. But when that horizontal line intersects the lower edge of the rising GMMA, that tells us it's time to change the stop-loss calculation for the trend. So amplitude is the distance between lower and upper edges, and that horizontal line is the duration, the amount of time that current stop-loss is relevant for this trend. And that will be quite different to any short-term stop-loss adjustments you might make related to price.
Interesting.
It's telling us about the trend, not about price behaviour. Again, repeat the behaviour, amplitude, duration, because typically at the end of a long-term trend, what happens is the long-term GMMA begins to compress as investors join sellers. Sellers start to take profits, investors, I think you've got to get out as well. So you see this compression developing. When the compression develops, what you find is a tightening of the stop. The amplitude decreases. The duration might increase, particularly as the trend begins to move sideways, but it may then go up, of course, in which case your amplitude will increase again, but if it drops below that, you're out of the trade. So you're defining the trend, not the price.